Hello, you're here today with Susan Hayek, the head of the Group Pension Division at Brokers Alliance, talking about qualified retirement plans. We're going to go through a little bit of an introduction today, and I want to take you through that with me. First thing is first, we're going to talk a little bit about employee benefit plans. There are actually two categories of employee benefit plans. There's welfare plans, which provide a wide variety of benefits that range anywhere from vacation pay to health insurance. And then there are also pension benefit plans, which is what we're going to concentrate on today. And those are the kind of plans that actually provide retirement income or result in the deferral of taxable income until distribution so that you can save for retirement. Okay, now what's interesting is by definition, a plan, a qualified plan, is something that satisfies the requirements of Internal Revenue Code 401A. Now, to everyone who's listening to me here today, what does 401A mean? Well, that's the Internal Revenue Code that actually qualifies plans and talks about how plans are set up. But by practice, the reality is a retirement plan is a vehicle to save tax deferred, or what I'd like to refer to as, and what you need to refer to as, it is the perfect place to save with tax benefits. Okay, there are two categories and types of plans. You've got defined contribution and you've got defined benefit. Let's talk about defined contribution first. In a defined contribution plan, what you've got is the contribution is actually defined by the plan. And the value of the actual account for the participant is based on the contributions that are put into the plan, whether they be employee-related or employer-related, as well as the earnings. And then when you're ready to retire, basically what you get is what's in the account. The risk of these types of plans, defined contribution plans, are typically borne by the employee. The other types of plans are defined benefit plans. Those are contributions that are based on a future benefit that's going to be paid for you, or it's defined by the benefit that you want at some later time in the future. The risk on defined benefit plans is actually borne by the employer because they're responsible for making sure that the plan is set up and is operating on the premise that, based on the contributions that they're putting in the plan, that that benefit is going to be available for you upon retirement. There are some major legislative acts that have occurred in the past. The initial one that established a lot of the plans that exist today is ERISA, the Economic and Recovery Income Security Act of 1974. There was a Tax Reform Act in 1986 that actually established limits on certain plans as far as how much money you could actually put in the plans. And then most recently we've got the Pension Protection Act of 2006, which clearly defined on the defined benefit side the availability to offer cash balance plan, which is a type of defined benefit plan. And it also talked about participant disclosure. It came up with what we call QDIAs, which is a qualified default investment alternative for 401k plans, and then other things that are actually qualified under the law. It was actually enacted on August 17th of 2006. And again, as I stated, it contains laws that increased and related to the funding of defined benefit plans, which is important to anyone who's actually establishing a defined benefit plan today. It contained a lot of changes altering the administration of plans as well. And that's important if you're going to be working with a third-party administrative firm or any other vendor in a qualified plan environment. What it defined for defined contribution plans was that basically quarterly benefit statements must be made available to participants. It also quantified a lot of investment advice, and then it introduced us to potential fee disclosure, which is 408B2 under the Internal Revenue Code, and it is a full disclosure of fees that are actually charged in plans. Again, kind of going back to our defined benefit plan, as we discussed before, the difference between defined benefit and defined contribution plans. What Pension Protection Act of '06 did for defined benefit plans is it actually overhauled the entire funding mechanism of how plans are funded from a contribution perspective. It clarified the status of cash balance plans. IBM was the first company. A lot of times what will happen, let me regress just a little bit, is what actually happens on the large plan market, large employers, basically your Fortune 50, Fortune 100 companies. What they're doing with some of their employee benefit plans are what ends up being enacted into law and then trickles down to what we would call the smaller plan market, which is probably the market that you're going to be going after in that respect. But basically what it did is, for defined benefit plans, it overhauled the funding requirements for defined benefit plans, which needed to happen. It did clarify that status for those cash balance plans, which IBM started to begin with. They had a cash balance plan. They took their traditional defined benefit plan, put it into a cash balance plan, and then there were an awful lot of controversy by the employees who were sure that they were somehow getting the short end of the stick. There was a lot of litigation that occurred. There were lawsuits that were filed. And then what ended up culminating was that the cash balance plan was deemed to be a plan that was a qualified replacement for the former pension plan that IBM had in place for their employees. It also expanded, though, the reporting requirements and also some of the compliance requirements for defined benefit plans, which means that there's an awful lot of scrutiny where those plans are concerned. So if you're planning on establishing a defined benefit plan, you want to make sure that you're working with a qualified actuary who knows all of these rules and regulations and can help you establish that plan correctly for you. One thing we want to get into is who actually establishes a plan. Who is interesting. An individual can establish a plan. If I'm a sole proprietor or I work for myself, a lot of times what will happen is I want to have some type of a plan. IRA deduction limits are, I can only contribute $5,000 to an IRA. If I want to actually put more money than that away, then I'm actually looking at setting up a qualified retirement plan, whether that's a defined contribution plan or potentially a defined benefit plan. I would work with someone to determine which plan is best for me. An employer. Now, what's interesting is any employer who's got a small company or a medium-sized company or maybe even a large company, and that would include corporate clients, i.e. I'm basically a C-corp, S-corps, partnerships, LLCs, anyone who has any kind of earned income in that respect, whether it's 1099 income, W-2 income, or any other type of an income. Now, why would anyone want to set up a plan like this? Well, two reasons. Number one, if I'm self-employed or I'm an employer, tax benefits. I'm allowed to put money away tax-deferred, and it grows tax-deferred, and I'm not taxed on that money until I take it out of the qualified plan status. But also, too, in a corporate environment, one of the main reasons why I'm going to set up a qualified retirement plan is employee retention and employee actual recruitment. That's going to be huge. That's one of the main things. Aside from healthcare, there are two things that are always asked when someone's interviewing for a job anywhere is, am I covered by healthcare, and do you have a qualified retirement plan or a 401k plan? So these are huge things that are going to be important to you as you're prospecting for clients in that respect. Things you need to be aware of, though, and things that become important is who are actually the owners of the company. What you'll find is sometimes, especially with smaller, closely held companies, you've got a person who's the owner, could be a man or a woman, they have a spouse, they might have children who work in the business, they might even have relatives who work in the business. And that information all needs to be known because there are what's called family attribution rules in plans that actually determine who are the highly compensated employees or the top paid people, and then who determines who are the non-highly compensated employees in the plan. Controlled groups play a part too. Sometimes what will happen is you've got a business owner who not only owns one company, he might own 2 or 3 companies. And the reality is, depending upon that ownership interest, he might have to actually combine them all or include them in the plan that he's considering setting up as well. So those are important things you need to know about. Another term that's going to come up into play when you're actually setting up a plan is who's the fiduciary, or who is a fiduciary of the plan? Well, actually, it's identified in the plan document. The employer is a fiduciary because they're setting up the plan. Anyone who's got control over the assets, plan management of the assets, any investment advice that they're giving, and anyone who acts under the direction or the administration of the plan, they are considered a fiduciary. Now, there are people that are not necessarily considered a fiduciary under current regulations, and that would be if I, as the owner of a company, I'm the trustee of the plan, I hire a third-party administrative firm. Technically, that third-party administrative firm, because they're doing ministerial duties for the plan, they're not considered a fiduciary, but me, as the owner, I'm still considered a fiduciary of the plan. Okay, now, what you probably want to know is what types of qualified plans are there out there and available for me? You're probably used to dealing with IRA accounts, or what we call simple plans, which are very easy to be established and very, very quick to set up, and they don't cost a whole lot of money, but you are limited into some of the things that you can do. Like I was saying earlier, In an IRA, I'm limited to only $5,000 from a contribution perspective. You've got profit sharing plans, money purchase plans, 401k plans, ESOPs, 403Bs, 457s, defined benefit, cash balance. There's a plethora of plans that are available for you. The trick is to gather as much data about your client as you can to determine which plan or combination of plans is best for them. Again, as I stated, in a simple plan, basically it's a savings incentive match for employees. It's the easiest to set up, but you are limited to certain types of contribution limits. Profit sharing plan is probably based on a defined contribution plan, the most established and probably the longest running plan. I can actually give a proportional contribution to my participants in the plan, or I can cross-test it. I've got vesting, and 5,500 forms have to be filed on every single one of these plans. 401k plan is probably the most popular plan that exists out there, and we're going to talk about that in more detail in another vignette a little bit later. Money purchase plans were very popular until about 2002 when tax laws changed that allowed up to a maximum of 25% into a profit sharing plan, so there wasn't a need for a money purchase plan anymore. However, they do still exist out there. Stock bonus plans, ESOPs, we've all heard of those, but they're primarily used to fund, and they're funded with company stock. And then you've got your 403Bs that are used by a lot of school districts, tax-deferred accounts, tax TSAs, and then 457s, which are non-qualified deferred comp plans for government employees and government entities. Again, a defined benefit plan is going to be a promise to pay a future benefit in the future. Again, a defined benefit. A cash balance plan is a defined benefit plan that carries individual balances, so it kind of acts like a DC plan, but it truly is a defined benefit plan. There are limitations for every kind of these qualified plans that are actually set up, and those limitations change from year to year from a qualified perspective. What will actually happen is the elective deferrals for 401k plans right now in 2011 is set at $16,500. There is a catch-up that's available for 401ks, 403Bs, 457s, and what's called SARSEP plans. We didn't really get into SARSEPs, that's for another day. And that is $5,500. Defined benefit plans, their limit is $195,000. Defined contribution plans, the limit to put into that plan is $49,000 on a defined contribution perspective. And then the annual compensation limit, i.e. the compensation I can take into consideration when I'm looking to set up a plan is, regardless of what my income is, I can never take compensation in excess of $245,000 into consideration in making my contributions. And then as before, simple plans, their limit is only $11,500. That's where I kind of go back to saying, you know, simples are easy to set up and they're probably fairly easy to run, but your flexibility, your capability of funding is much more limited than a regular profit sharing plan or a 401k plan. So taking into consideration all of these plans, the first thing you need to do is gather information and then determine what is the best plan for my client to set up based upon their own parameters. So I'm going to go ahead and leave you today with just this basic knowledge and information regarding qualified retirement plans, and hope you join me back for another session. Thank you.